Welcome to Professor FinTech. If you are looking to enhance your financial knowledge, you have clicked on the right video. Today we will dive into the fundamental concept of accounting. What is accounting? Why do we use it? What are debits and credit? We will cover all these essential topics to ensure that even if you don't have a background in finance or accounting, you will be able to grasp the concept easily. So be sure to watch this video until the end to fully understand the basics of accounting. Let's understand what is accounting. Let's consider an example involving a grocery shop. As the owner, you purchase products from your vendors and sell them to your customers. Suppose you buy $100 worth of a product from a vendor and later sell that same product to a customer for $120. At first glance, it may seem that your profit is $20. However, this conclusion is incorrect. When you purchase a product of $100, additional cost may be incurred during the transaction. These include transportation expenses to bring the product from the vendor's location to your shop, as well as various selling costs. For instance, you might need to invest in electricity bills, furniture, or equipment such as freezer if the product requires refrigeration. Additionally, you may need to hire delivery personnel to transport the product to your customers. When you take all these costs into account, the actual profit derived from your $100 investment may be significantly lower. Consequently, it's essential to meticulously record each transaction in your business. This is where accounting becomes crucial, enabling you to determine whether you are making a profit or incurring a loss. Now, let's move on to the essential components required for effective accounting. Accounting is the systematic process of recording, classifying, summarizing, and analyzing financial transactions and information in a meaningful format. It involves tracking an organization's income, expenses, assets, liabilities, and equity to provide an accurate picture of its financial health. Accounting serves as a foundation for financial reporting, decision-making, and compliance with legal and regulatory requirements. Above, I have highlighted a few keywords as they are essential to understanding the concept of accounting. Please take note of these terms: recording, classifying, summarizing, and analyzing financial transactions. These words are fundamental to accounting. Overall, accounting is often referred to as the language of a business because it translates complex financial data into understandable information that can drive decision making and strategic planning. Key components of accounting include bookkeeping, recording all financial transactions such as sales, purchases, income, and payments in a consistent and organized manner. And then second component is financial statements. Preparing key financial reports such as balance sheet shows the company's assets, liabilities, and shareholders' equity at a specific point in time. Second financial statement is income statement, shows revenues, expenses, and profit or loss over a period of time. And third financial statement is cash flow statement, reflects the cash inflows and outflows during a period of a time. Remember these two key terms, bookkeeping and financial statement. We will explore them shortly. Accounting process. This process has 5 elements. The accounting process comprises 5 key elements, which I will outline below as we proceed. I will explain each element in detail, including its significance within the accounting framework. The first 4 elements are collectively referred to as bookkeeping, while the 5th element is known as financial statements. Bookkeeping involves systematically recording financial transactions, serving as the foundation for accurate financial reporting. The financial statement, on the other hand, presents a summary of this data, which is essential for stakeholders, management, and government agencies. Understanding these elements is crucial for effective accounting process. Now let's dive deeper into their meanings and significance in the field of accounting. Source document. In accounting, we cannot record any transaction without supporting documentation. This documentation can include invoice or receipts received at the time of the transaction. These supporting documents are crucial for validating entries before we record them in the accounting book. Journal entry. Journal entries is the initial record of a financial transaction. It captures the details of the transactions and is made in the journal. Each entry typically includes the date, accounts affected, amounts debited and credited, and brief description of the transaction. Journal entries are recorded chronologically, meaning they list transactions as they occur. And then second is a double entry system. The dual entry system in accounting refers to a method where every transaction is recorded in 2 accounts, one as a debit and the other as a credit. For example, when you purchase a product from a store, 2 key transactions occur. First, you receive the product, which increases your inventory, and the second, you pay for it, decreases your cash. In this scenario, the product enters your assets while cash exits, necessitating the posting of both transaction in accounting books. This fundamental principle underlines the dual entry system. Let's deep dive this with the example. Journal example. The business ABC Retail sells goods worth $2,000 on a credit. Debit increases the accounts receivable by $2,000, indicating money owed to the business. The entry increases the accounts receivable account because the sale was made on credit, meaning the business expects to receive $2,000 in cash in the future. The credit sales revenue account by $2,000, indicating income earned from the sale. The entity increases the sales revenue accounts, reflecting the income earned from the sale. The general entry will later be posted to the ledger accounts for accounts receivable and sales revenue, ensuring that ABC Retail can track its sales and outstanding receivables efficiently. Let's understand the general ledger. The general ledger is a master account that contains all of the financial transactions of a business. All journal entries are posted to the general ledger and provide a summary of the financial activity of the business. Structure of the general ledger. The general ledger is a comprehensive record of all the financial transactions of a business organized by account. Each account has a unique account number and contains transactions related to that account. Posting transaction to the general ledger. When a transaction occurs, it needs to be recorded in the general ledger. This is done by posting the transaction to the relevant account in the ledger. The transaction is then recorded as a debit or credit in the account as appropriate. Creating an account in the general ledger. To create an account in the general ledger, you need to determine the account type and account number. The account type determines the category of account such as assets, liabilities, equity, while the account number is unique identifier for the account. Let's deep dive with this example. We will take example same that we use for the journal entries. Now we are using the same example for general ledger. A business, ABC Retail, sells goods worth $2,000 on credit. So now remember what we have learned in the journal entry. This is accounts receivable account debit to sales account. So now we will have each separate general ledger for each of these accounts. So accounts receivable have a separate general ledger. Sales account will have a separate general ledger. And these entries, journal entries that we posted on a general account, will be moving to the ledger account, general ledger. So sales revenue $2,000 debit, because this is the debit of at accounts receivable account, and this sales account which was credit here, which will be remain credit here with the particular as a accounts receivable, because we yet to receive this payment. Hope you understand what exactly general entries and general ledger, difference between two things. Now we will move on to the next part, that is trial balance. Trial balance is an internal report that lists a summary of all the accounts in the ledger and their balances. It is used to ensure that the debits and credits in the ledger are equal. It helps ensure total debits equal total credits before financial statements are prepared. Typically, trial balance consists of two columns. List all accounts with debit balance, list all accounts with credit balance. And purpose of the trial balance is to check the accuracy of the accounting entries that we have posted in the journal entries as well as ledger. So here is the checkpoint before we create a final balance sheet or a profit and loss account or income statement. So before we move to the financial statement, this is the checkpoint you can consider. Take an example. To move transaction from the general ledger to trial balance, you will summarize the account balances from the general ledger. So we have already seen in the previously, these are the general ledger. So the entry that was posted on a journal entries move to the general ledger, and now from the general ledger it will move to the trial balance. So balances of these accounts, balances from the general ledger accounts, and list them in the debit or credit side of a trial balance. The trial balance provides a snapshot of all accounts at a given point in time, ensures that total debits equal total credits. So it has to be total debit equals to total credit. And importance of a trial balance is, as I mentioned before as well, let me reiterate the same thing. A trial balance is essential for identifying discrepancies in bookkeeping and serves as a preliminary step in the preparation of a financial statements. It helps accounts ensure that transactions have been recorded correctly before moving into more complex areas of a financial reporting. So let's move now on the more complex areas of a financial reporting, right? That is a financial statement. Financial statement including the income statement, balance sheet are generated from the trial balance. These statements provide detailed information of a company's financial performance and position. These statements provide a clear picture of a financial performance and are used by the various stakeholders, including management, investors, creditors, regulators, to make informed decisions. So if you are an investor, be careful when I'm explaining this one, and of course we will deep dive later on. This is the basic that I'm giving you the understanding of a financial statement. So in financial statement, first financial statement is an income statement. And the income statement is one of the main financial statement used to assess a company's financial performance over a period of time. It provides a summary of revenue and expenses and shows whether the company made a profit or loss. So here I have deliberately highlighted company's financial performance over a period of time. So you have to remember, over a period of time. Income statement is prepared for over a period of time. For example, 1st January to 31st December, what was the company's profit or loss? What was the revenue or expenses? This will be presented in the income statement. Let's deep dive with the example. Financial statements example, income statement. So as I mentioned, over a period of time. So 1st January 2026 to 31st December 2026, we will conclude whether company is making a profit or loss. So it will have in 3 columns: particulars, amount, and amount. So sales, cost of goods sold. So $2,000 is the sales. Cost of goods sold is $500. So total the cost that has incurred is $2,500. Then operating expenses is a salary, rent, $100, $150. These are the expenses. So $150 here. Operating income then, and finally net income of a statement. This is the income statement. So it will give the whether the company is making a profit or loss. Now next we will move on to the next part of a financial statement, that is balance sheet. The balance sheet is one of the main financial statements used to assess a company's financial health at a specific point in time. It provides a snapshot of a company's assets, liabilities, and equity. So here again I have highlighted company's financial health at a specific point in time. What I mentioned in the previous statement, that is income statement, over a period of time. And here I'm mentioning specific point in time, means on a specific date, today, as of now, what is the state, what is the financial health of an organization. So how it will be, how we can measure how many assets, properties company has, right? How many, what are the liabilities, how much we owe, how many we have to pay to our vendors or lenders, right? So that's what it will be defined. And then equity, what is our own interest in the organization. So let's see with the example. But remember, this company's financial health at a specific point of time. So this is the balance sheet. So balance sheet has a two side, assets and liability. Assets means what the entity owns. That is what is we own. What is our what is our ownership. That is cash, inventory, property, whatever the ownership will be in the assets. And second is a liability. Liability, what the entity owes. That is we supposed to pay to others, right? To vendors or from whom we took loans or whatever the payments that we have to make. And then third part is the equity or owner's interest, the owner's interest in the entity. So assets has a current asset, non-current assets. Liability similarly has a current liability, non-current liability, and equity, right? So now, as I mentioned, this is the basics of accounting. We will not be covering too much of a details of a balance sheet, each of the heads in the within balance sheet. There are multiple things, but this is very important in making a informed decisions when you are investing in a certain company. So you can write in the comment if you want to have a detailed understanding how this balance sheet needs to be read. So now we have covered only the basic of accounting, but we can dwell deeper into this subject in a new videos. So let's move on to the next topic of a financial statement, that is cash flow statement. The cash flow statement is one of the main financial statements used to show how changes in balance sheet accounts and income affects cash and cash equivalents. It provides a summary of the company's cash inflows and outflows during a given period of time. This is what you have to remember, right? Income statement over a period of time, so for a year or for that, right? Balance sheet on a given at any point of a time, right? Specific point in time, it will give the health of a financial. And cash flow is again during a given period. So for a certain period, how much is the cash inflow and out? There will be always any business that you are doing, you will have an inflow as well as outflow. Inflow, how? When you sell, customers will pay to you, and that will be inflow in the cash, right? Or other sources as well to inflow cash, right? And outflow, when you purchase product from your vendors and you have to pay to your vendors, so these are the outflow. So this will be captured in the cash flow statement. So let's deep dive into the cash flow statement with the example. This is the cash flow statement example for the year ended 31st December 2026. So for the year ended, so when it will start the year end, here 1st January, so it is ending on a 31st December. So 1st January to 31st December, whatever the cash inflows and outflows has happened in the organization, that will be captured. Cash flows from the operating activity, net income, depreciation of fixed asset, decrease in current assets, accounts receivable, inventory. Cash flow from the investing activities, cash flow from financing activity. So as I mentioned previously as well, we are covering only the basics of accounting. We can deep dive into this cash flow statement in the future videos. So you have to subscribe for that, and so you will get the notification of this. Cash flow from investing activities. So when you are investing, there might be a loss or even gain, right? That means there is whether you earn from the investing or you lose the money. So that will be mentioned here. Cash flow from financing activity and cash flow from operating activities. That is daily whatever your business is, right? From through those activities, how much whether you earn or lose, what are the cash. In a conclusion, accounting is a systematic process of recording, classifying, and summarizing financial transactions to provide meaningful information to stakeholders. Who are the stakeholders? Be it investors, creditors, management. So these are the stakeholders, right? So this information will help investors, creditors to use statement to assess profitability, liquidity, and solvency before making investment or lending decisions, right? Management use these statement to evaluate operational efficiency and performance over the period of time. And compliance and reporting. So government require for a legal compliance and for regulatory agencies to ensure transparency in a financial reporting. You wanted to do the forecasting and historical data from financial statement can inform future business strategies and budget. So in a conclusion, the key elements of accounting include source documents, journal entries, ledger accounts, trial balance, and financial statement. Understanding these elements is crucial for interpreting a company's financial position and performance. By mastering these fundamental concepts, one can effectively manage and analyze financial data, aiding in informed decision making and strategic planning. We have covered the basics of accounting, but if you want to delve deeper into the subject, subscribing to our channel and liking this video. This way, you can easily access our latest videos that provide detailed insights into all these topics and more. Thank you for watching the video. Don't forget to like and subscribe to our channel for the latest updates.